Okay, thank you, everybody. I'd like to call this meeting of the Council to order. Let me note for my colleagues that Controller Otting, Commissioner Cooper, and President Williams are joining us by telephone. They couldn't be here with us in person today. We have 3 agenda items today. First, we'll hear a presentation and vote on the Council's 2019 annual report. Second, we'll hear a presentation and vote on the Council's final interpretive guidance on non-bank financial company determinations. And then finally, we'll vote on the minutes of the Council's previous meeting. So let's turn to our first agenda item. FSOC's annual report is the product of extensive analysis and collaboration across all the Council members' agencies. It provides our comprehensive assessment for the public of the Council's view of potential risks across the financial system. It also includes recommendations to enhance the integrity, efficiency, competitiveness, and stability of the U.S. financial markets. This report highlights recent accomplishments in areas where further work is needed. I'd like to thank the members of the Council and their staff for the hard work for preparing this year's report and for their ongoing efforts to make the financial system stronger and more resilient. Let me turn to Stephen Ledbetter from Treasury Department, who will provide an overview of this report, its findings and recommendations.
Thank you, Mr. Secretary. The Council reports annually to Congress on significant financial market and regulatory developments, potential emerging threats to U.S. financial stability, and the Council's activities. The statute also requires the annual report to include Council recommendations to enhance U.S. financial markets, promote market discipline, and maintain investor confidence. This year's report notes the continued strength of the U.S. economy as reflected in low unemployment rates, low corporate and consumer delinquency and default rates, and financial conditions that are broadly stable. The report states that overall risks of U.S. financial stability remain moderate. Nonetheless, the report emphasizes the importance of remaining vigilant regarding potential emerging threats to financial stability, identifies potential vulnerabilities, and makes recommendations for addressing them. I'll spend the next few minutes highlighting some of the key topics raised in this year's report. First, cybersecurity risks. The report notes the increasing reliance of the financial system on information technology and the increased risk for institutions to experience a severe cybersecurity event. The report includes a number of recommendations, including that Council member agencies continue IT and cybersecurity examinations of financial institutions and infrastructure. The report also encourages continued cooperation across government agencies and the private sector through the use of existing partnerships, such as the Financial Banking Information Infrastructure Committee. Another issue highlighted in this year's report is the anticipated cessation or degradation of LIBOR and the importance for markets of the transition to the use of alternative reference rates. The report notes the risks to institutions that fail to adequately prepare for the transition away from LIBOR and discusses the work of the Alternative Reference Rates Committee and others to facilitate the transition. The report also includes recommendations regarding the importance of market participants formulating and executing transition plans and of Council member agencies using their authorities to identify and mitigate risks from potential dislocations during the transition process. A third issue discussed in the report is the increase in borrowing and leverage by non-financial businesses. By several measures, leverage is elevated relative to historical averages. This increased borrowing reflects, in part, the strong performance of the U.S. economy and expectations for continued economic growth. Strong interest coverage and liquidity positions have allowed businesses to service their debts with low delinquency rates. However, the report notes the potential for conditions to change. Any potential impact on financial stability depends on a number of factors, including the severity of market losses and the extent to which market participants are adequately capitalized and hold liquid assets. The report therefore makes a number of recommendations, including that agencies continue to monitor levels of non-financial business leverage, trends in asset valuations, and potential implications for the entities they regulate in order to assess and reinforce their ability to manage losses. Also featured in this year's report is the risk associated with the increasing share of residential mortgages originated and serviced by non-banks. The report discusses the potential fragility of the non-bank business model, and it includes a recommendation that federal and state regulators coordinate in collecting data, identifying risks, and strengthening oversight of non-bank mortgage companies. Fifth, the report highlights technological innovations in the financial system, including the growth of digital assets and distributed ledger technologies. The report notes that if digital assets were to become widely adopted as a means of payment or a store of value, disruptions could affect the wider economy. The report therefore encourages continued coordination among U.S. financial regulators, including through the Council's Digital Asset and Distributed Ledger Technology Working Group, to promote consistent regulatory approaches and to identify and address potential risks. Sixth, this year's report reaffirms the Council's view regarding the urgency of housing finance reform, and it discusses developments in this market over the last year. The report recommends that the Federal Housing Finance Agency continue to develop capital and other prudential requirements for Fannie Mae and Freddie Mac to help inform their application to future secondary market housing entities upon completion of housing finance reforms. The report also recommends that regulators and market participants take steps to encourage a larger role for private capital in the housing finance system. Finally, the report discusses some of the actions that Council member agencies have taken to enhance the efficiency of financial regulation by tailoring regulation to the risks posed by firms and activities. The report recommends that federal and state regulators continue to work together to evaluate regulatory overlap and duplication, modernize outdated regulations, and, where authority exists, continue to tailor regulations based on the size and complexity of financial institutions. The development of the report was truly a collaborative effort among all of the Council members and member agencies, and it provides a clear view into the Council's deliberations over the last year. I'd be happy to take any questions.
Thank you very much. Does anybody on the Council have any questions? Okay. In the absence of any questions, I know there's a lot of work that's already gone in, so I'm sure everybody's had an opportunity to ask along the way. Is there a motion to approve the resolution approving the Council's 2019 annual report?
So moved.
Is there a second? All in favor?
Aye.
Any opposed? Terrific. The resolution is approved. Okay. The final interpretive guidance the Council is voting on today is the culmination of nearly 2 years of work by Council members and their staffs. We make these changes after careful consideration, including review and analysis of public comments regarding the proposed guidance, which were largely positive. The final guidance makes significant enhancements to how the Council identifies, assesses, and responds to potential risks to the U.S. financial stability. With the adoption of the final interpretive guidance, the Council is prioritizing an activities-based approach that will rely on the expertise of existing regulators to address potential risks to financial stability. In addition, the guidance enhances the Council process for evaluating non-bank financial companies for potential designation by increasing transparency and analytical rigor. Let me turn it over to Howard Adler from the Treasury Department for the presentation.
Thank you, Mr. Secretary. The interpretive guidance the Council is voting on today would replace the Council's existing interpretive guidance on non-bank financial company determinations, which was adopted in 2012. This past March, the Council voted to issue the proposed guidance for public comment. The Council received 26 comments, the vast majority of which supported the Council's proposal. The final guidance describes the approach the Council intends to take in using an activities-based approach. The key focus of the guidance is on the Council working with the relevant financial regulators to identify products, activities, or practices that could raise potential risks to financial stability and to address those risks, thereby leveraging the expertise of primary financial regulatory agencies. It also includes a series of reforms designed to enhance the analytical rigor and transparency of the process the Council intends to follow if it were to consider designating a non-bank financial company, including a cost-benefit analysis, the consideration of the likelihood of the company's material financial distress, and both pre- and post-designation off-ramps. The guidance states that the Council is most likely to pursue entity-specific non-bank designations only in rare instances, such as if the products, activities, or practices of a company that pose a potential threat to U.S. financial stability are outside the jurisdiction or authority of financial regulatory agencies. The guidance also emphasizes the importance of market discipline as a mechanism for addressing potential risks to U.S. financial stability. The guidance would establish a two-step process for the activities-based approach. First, the Council would monitor markets to identify and assess potential risks to U.S. financial stability. If in the first step, the Council identifies a risk to financial stability, then in the second step, the Council would work with relevant regulators to seek the implementation of actions intended to address the potential risks. In response to comments, the guidance provides detail regarding how the Council will take into account the risk profiles and business models of market participants engaging in the products, activities, or practices under evaluation. The final guidance also requires a cost-benefit analysis if the Council seeks to issue any formal non-binding recommendations to a regulator under Section 120 of the Dodd-Frank Act. This cost-benefit analysis would be performed either by the existing regulator or by the Council, depending on circumstances as described in the guidance. If a potential threat cannot be addressed through an activities-based approach, the Council may evaluate a non-bank financial company for a potential determination. The guidance would make several changes to enhance the analytical rigor and transparency of the non-bank designation process. To make the designation process clearer, the guidance condenses the current three-stage designation process into two stages by eliminating current Stage 1. To enhance analytical rigor, under the guidance, the Council would perform a cost-benefit analysis prior to designating any non-bank financial company. Only if the expected benefits from the designation justify the expected costs would the Council make the designation. The Council would also assess the likelihood of a non-bank financial company's material financial distress when evaluating the firm for potential designation. Both the cost-benefit analysis and assessment of likelihood have been revised in the final guidance to provide greater clarity about how the Council would perform those analyses. To promote transparency, the guidance would also increase the Council's engagement with companies and their existing regulators before and during the designation process. The increased engagement would provide a company with a potential pre-designation off-ramp. The guidance also includes procedures intended to clarify the post-designation off-ramp. Finally, the guidance in response to comments requires a vote of Council principals to move from the activities-based approach to consideration of a company for potential designation. I'd like to thank all of the Council members and their staffs, and also the FSOC staff, for their tireless assistance in developing these important changes over the past year. And I would be happy to take any questions.
Howard, thank you very much. Are there any questions for Howard? Thank you. We appreciate all the work that the Council has done on this and appreciate the final review of this. Is there a motion to approve the resolution approving the final interpretive guidance regarding non-bank financial company determinations?
So moved.
Is there a second?
Second.
All in favor?
Aye.
Aye.
Any opposed? The resolution is approved. For our last agenda item, there's a vote to approve the minutes of the Council's last meeting. Is there a motion to approve the resolution approving the minutes of November 7th, 2019 Council meeting?
So moved.
Is there a second? All in favor?
Aye.
Any opposed? Terrific. The resolution is approved. Thank you very much, and we're now adjourned.
Nice job. That's great.
Thank you. Thank you, Tom. I appreciate that.
Summary was great. Yep.
Good job. Good job.